Hello there, and welcome back to another episode of TA with MK. My name is MK. This is part 2 of our deep dive into CPI, or the Consumer Price Index, which we spoke about in yesterday's part 1 video. We'll refer to it actually in this video as the inflation gauger. And in today's video, we're going to dive into the mud, actually into the oil, so to speak, because we're going to look at the oil chart a little deeper, because as I mentioned in yesterday's video, I think that that could be one of our key clues as to when inflation has potentially found its peak, and maybe, just maybe, it can tell us clues as to when is the best time or times to accumulate stocks, or in our case, Bitcoin and altcoins. If you guys are liking the content, as always, do me a huge favor and remember to like and subscribe, and let's go. It's TA with MK. It's TA with MK. Now, for those of you that missed yesterday's video, I would recommend checking the link in the description for part 1 if you want to get the more deep dive into exactly what CPI is. I'm going to read another definition from Instapedia real quick in this video as well before we move on and get into the nitty-gritty of the charts. But I just wanted to mention that if you don't know what CPI is overall and want a little bit more in-depth, explanation of what it is, check out that video as I explain it a lot better in that one. But I will read this definition from Instapedia. It says, what is Consumer Price Index? The Consumer Price Index, or the CPI, measures the monthly change in prices paid by U.S. consumers. The U.S. Bureau of Labor Statistics, or BLS, calculates the CPI as a weighted average of prices for a basket of goods and services representative of aggregate U.S. consumer spending. Now, that basket of goods and services, I dived in a little bit deeper in that video I made yesterday. They actually say that it's around 80,000 different items that they put different weight on, and what they are is just the different things that we as a average American buy day to day over the course of a month. Things like whether we're paying our rent or going to the doctor or buying food or clothes. The bigger ones they put higher weight on would be things like gasoline, right? And the energy to heat and cool our house, or things like that. So watch that video if you want a deeper dive, but I wanted to just quickly read that again in today's video, as well as we're going to hop over here and read what the definition of the, the big buzzword lately, or the word out here that has everyone scared, which is recession. And Instapedia defines that as a recession is a macroeconomic term that refers to a significant decline in general economic activity in a designated region. It had been typically recognized as 2 consecutive quarters of economic decline as reflected by GDP in conjunction with monthly indicators such as a rise in unemployment. However, the National Bureau of Economic Research, or the NBER, which officially declares recessions, says the 2 consecutive quarters of decline in real GDP are not how it is defined anymore. The NBER defines a recession as a significant decline in economic activity spread across the economy lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. And heck, why not? Let's just read what the definition of GDP is in case that's something else that you're unaware of. Now, it stands for the gross domestic product. And a gross domestic product, GDP, is the total monetary or market value of all the finished goods and services produced within a country's borders in a specific time period. As a broad measure of overall domestic production, it functions as a comprehensive scorecard of a given country's economic health. Though GDP is typically calculated on an annual basis, it is sometimes calculated on a quarterly basis as well. In the US, for example, the government releases an annualized GDP estimate for each fiscal quarter and also for the calendar year. The individual data sets included in this report are given in real terms, so the data is adjusted for the price changes and is therefore net of inflation. So why is crude oil so darn important, and why would that be the chart I would be focusing on? Well, as you know, or maybe you didn't, but most of you probably do, crude oil is used to make a gasoline. I even added this little info on the chart that I'll read real quick. Gasoline is made when crude oil is broken into various petroleum products. Through a process of fractional distillation, the finished product is then distributed to gas stations through pipelines. Gasoline is essential to running most internal combustion engine cars. Yeah, it's definitely essential. And if you think about it as simple as this, the majority of products are transported via, across this great United States via some form of transportation, which in most cases require fuel. And, whether that's planes, or semis on the interstate and so forth, which is what I discussed in yesterday's video. So to me, it's probably one, if not the most important gauge as to whether or not, prices are going to be inflated on the majority of products in our country or deflating, right? Because if the cost of a barrel of oil is so high that it's costing a lot more to make fuel, and that then the gas stations are then of course charging more for fuel. Well, now the company that received the product had to pay more because it costs more to get it to them. It just goes down the line till eventually you as the consumer pay higher prices. So it affects basically the price of everything, or the majority of things. So just out of the gates, this is the oil chart, and it's got data going clear back. We'll just right here looks like kind of where it all starts, clear back to the early 80s. So you have data here. This is the weekly chart going from the 80s clear until the current point in time. And what I was focusing on was just comparing kind of what price action did during our last recession, our last major recession, which, as you would know, would have been in 2008. That would be the one I think we would want to compare this to. We just recently had inflation numbers come up that were higher than even back then. So we are at the highest level of inflation that we've been since 2008. In fact, we've even exceeded it. And so to me, that only makes sense to focus on that time frame. And what I've done on this chart, I've broken down a few very, very simple things, and we'll kind of compare this chart with, I'm going to use the NDX or the NASDAQ chart. Normally I use the S&P 500, but I kind of had that chart a little messy from charting it day to day. And rather than hide all that or delete it, I just decided to focus on a chart that's similar, which would be the NDX or the NASDAQ 100. So we're going to be comparing some time frames between the two. But the first thing I want to focus on is, if you look back here, this is the highest that a barrel of oil has ever cost, which would have been at the peak of late June of 2008, right? A barrel of oil was going for around $147, almost $150 for one barrel of oil, which even now, as you can see, we're really at 96. That's still a 50% increase even from where we are now just to get to there. So that was pretty crazy times that you're paying that much for a barrel, for a barrel of oil. I'm sure fuel, at least relative to the times, was probably insanely high. In fact, you know what? Let me look that up really quick. Okie dokie. So this was kind of a cool chart, and I'll leave a link in the description. It's www.eia.gov, and it's just a chart that shows us what the cost of gas, U.S. all grades, all formulations, retail gasoline prices. I'm guessing this is just average, of course, because it's going to be different across the country, but the average price of gas on any given month of any given year from 1993 clear till present time, right? And if you kind of look down just here, and we'll just use June down the middle as the example here, you can see back in the 90s, it was basically just over $1. 2000s, it was just, still kind of similar, but approaching more of the mid-range to closer to $2. And of course, it's going up over time. We know that. But then look at this crazy spike in June of 2008. All of a sudden, you were paying $4.11. So that is 14 years ago. The price of gas was similar to what it is right now, which they haven't got this month yet, but last month was $5.03. So that's pretty crazy to think about, especially when right after that, the following year in June, 1 year later, it was back down to $2.50. Just under 260, so that's a pretty big decline. So just thought I found that interesting, so I thought I'd share that with you. So the next thing that I found interesting is if you go back over here and we kind of scroll in a little bit, and zoom in, I should say, a little bit closer, so we can kind of just focus on that previous recession. So we saw that right around that time frame of June, that's when oil peaked, and the price of oil, of course, for that, the consumer at that time also basically peaked. If we go back to that chart, it was actually July, which was the next month, $4.11 was actually the highest month. So it peaked, and then the following month was the highest price in the United States at the time. But then you look back here and you say, okay, before this had its major run-up, what level was it at, that it previously was at for support? Back here, in January, early of that year of 2007, or I guess the previous year in 2007, you had this major level that had flipped to support, came back up, tested as support. Well, if you kind of look over here, around the end of the year of that year of 2008, so November-ish, that's when it had finally come back down to that same level. And sure enough, you go over there and look at the price of gas at the time. And at what point did the consumer start to pay less? Well, it started to come down, and here was one of the first big major changes. That was back below $3, in fact, closer to $2. And then the following month in December, so around that same time frame that it had found support there, gas dropped back below $2 even to $1.74. So more or less, it took roughly 6 months back in the recession of 2008 for oil to find its peak, of resistance, and then later find its bottom of support, right? But here's a key level we're going to discuss more as we go through this video, which I have marked with this, horizontal yellow line. Look what happened after it peaked, but then it came back down, lost this level right here, and then bearishly retested. It was a level that right before that, you know, back in March of 2008, had been resistance. It broke above it, found its all-time high, and then it bearish retested it right around September of 2008. If we go over here to the NDX, what was happening around that time? Well, when oil peaked, stocks actually, that was indicated by this vertical blue line here, they were actually down at support, right? So, you know, a lot of people would have expected a bounce. You did get a bounce. You did. That's going to be key as this video goes on. You did get a pretty good sizable bounce here where it actually went up all together around, you know, 11%, which is a pretty sizable bounce for, you know, stocks or the NASDAQ. And then right around that September time frame, when that, you know, oil was bearish retesting that level as resistance, that's when you saw the major capitulation of, you know, the NASDAQ at that point, where it lost that same support it was previously being held up by and dropped by another around 40% between that time and when oil actually found its support later that year. Then oil has some pretty sizable bounces down near that support, eventually putting in kind of a double bottom here, you know, 1, 2 bottoms, eventually flipped that as support and began its next trend higher. Well, this area right here ended up representing also the bottom for the NASDAQ, right? That would have been the best time to buy if you were brave enough, or if you believed that oil support was going to hold. But if we look over here when it flipped that double bottom, which happened as support right around, you know, late April of 2009, what was NASDAQ doing late April of 2009? April, May, right around here. Okay, that was this level. Same thing was happening. It was able to flip its own double bottom as support. And this would have also been, I would say, the safer time to buy. You would have missed out on this move, but you would at least known that, hey, this bottom is now getting confirmed kind of as a bottom because this double bottom, which is what it is, got flipped as support, and then NASDAQ went on a good run right after. And then things get even more interesting when you start looking at these next major levels. Now, we spoke about the yellow one already, which we'll speak about again when we get to this, you know, price action around here. But first you have this kind of blue zone where you have the top of the zone right back here where obviously price action for oil was rejected once, twice, you know, so this was acting as resistance, and then later it was able to break through and flip it as support. Well, focused back here on both times it got rejected, what was the NASDAQ doing at that time? Well, I've charted that out, and both times that was little, you know, tops, right? You had this top here, rejection, top here, rejection, pullback, right? And you'll just kind of see that as the common theme as we go through here. Now, again, once it was able to break through that level and flip it as support, as it did right here, right? Broke out, flipped as support. Well, then you had it travel up to that next major area of resistance. That was this area where back in, you know, the recession times was when, you know, stocks capitulated, you know, like we talked about on this chart. That was that area of resistance that once it bearish retested on oil, that's when we saw stocks drop this 40%, right? This big pullback. Well, you go over here and you look at when that now became resistance. Each time it was resistance and then it was flipping the blue zone as support. Those represented pullbacks each time that, you know, oil found resistance, and it was the bounces each time, you know, more or less that it found support. Now, it wasn't perfect, but generally speaking during that time frame, anytime you bought down in this area a stock, you know, it saw upside between this area, you know, this range it was in where it was just basically forming this large ascending triangle from basically April of 2011 clear till it broke down in 2014. So you had about 3 years there where it was just kind of ranging, and you could kind of know, hey, sell up here, buy down here, sell up here, buy down here, right? And it was really just that simple. Now we'll turn our attention to when the actual breakdown of the triangle happened, right? So you had this ascending triangle that it was in, this being the support on the bottom, you know, the resistance on the top like we just discussed. Well, once this actually broke down right here and came, you know, clear down to this previous big, you know, blue zone we just spoke about that was resistance here, support here, it was clearly a zone of interest. Well, that during that time period, you did see a pullback from stocks because that was this right here. That was this little pullback here to support. But the support actually held even though after that, fuel broke down. This was one of the few times that as I was tracking all this that you don't see the stocks pull back with fuel as it pulls clear back to here. Well, why would that have been? Well, there was a major difference between this time period when fuel made this giant drop and this time. This was a recession, meaning that everything you know, had peaked from inflation. Then you had the recession to follow, and everything just came down at the same time. Stocks, gas, all of it, right? Well, if you look over here on a simple Google search, now there's probably multiple factors, and I'm not going to give a history lesson, but it says here, I just typed in, why did oil drop in 2014? This is the first thing that popped up. It said, reduced demand in the second half of 2014 was also a major factor that had not been the case during the previous 2 years. Advancing petroleum supplies. An overall weakening of global demand for petroleum began in May, particularly from China and Europe. And then just to add to that, I also found this article that says supply glut reinforced by weakening demand prospects. It says the initial drop in oil prices from mid-2014 to early 2015 was primarily driven by supply factors, including booming U.S. oil production. And that pretty much told me all I needed to know. Now, I know there was other factors, but I'm not going to dive any deeper than that. But clearly they were producing way more oil than they needed at the time. They thought that was going to actually boost the economy, but really it didn't. It basically what it just led to is we had more oil than we needed, therefore the price went down. We know the rarer something is, the higher we pay for it, the lower it is, the less we pay for it. And so that was the major difference, is this wasn't a recession that led to the oil prices coming down. It was just a booming oil production. But consequently, if you still look, it didn't tell you a good time to sell in that case, or at least you wouldn't have capitalized selling all of your stocks during this oil plunge here. But when it finally found its bottom and began to go up in early 2016, you look over at the NDX, and sure enough, what was it doing in early 2016? It had just found support and went on another run. So clearly once oil began to go up, stocks went up with it. So probably the most important thing to discuss real quick before we analyze this further or look at current price action is that we can't expect this potential recession or, the inflation peaking and coming down to be exactly like it was in 2008. All we can do is look for major levels of support where we can expect stocks to bounce. If you want to make some short to mid-term trades, those would be the areas you'd be eyeing. And if you're looking for something longer term, then you need to wait for major signs of a bottom. Well, we're only very recently finding major signs of an official top. And it's not even official by any means, but it's as close as you can get, right? We had this peak back here in late February, a lower high put in mid-June. You have kind of this symmetrical triangle where the bottom was acting as support once, twice, 3, 4, 5, quite a few different weeks that acted as support. Well, you recently had that break to the downside, right? Which I spoke about in a previous video. We are now, bearishly retesting it. And so that would confirm the idea that we should start to now put in a series of lower highs, and lower lows. And, maybe we eventually form some sort of a large falling wedge. We don't know exactly what we're going to form. But the key is we're only recently breaking down as far as oil is concerned, which tells me that we have a long ways to go, potentially, to find a bottom. Now, back in 2008 through 2009, that found its bottom pretty fast, actually. It was a very violent drop. It played out over the course of just over 200 days. And if something like that happens this time around, where we're able to get inflation to peak, get under control very fast, things could get very ugly very fast. But if something similar happens, sure, we could maybe by the end of this year, by October, maybe November, December, we could potentially see, a bottom being put in. Where would that be? Hard to say. But if it's something similar that happened in the previous recession, what would that look like going forward for traditional stocks? Now, on the NDX or the NASDAQ 100, this purple vertical line represents when oil potentially peaked this time around. If this is to be the peak that happened in early March, well, on the NDX, that would be this vertical line. Would have had us at this support level, which was previously resistance, twice here. This is about where price action was at. If we saw something similar as far as a 40+% or around a 40% pullback from that point, which right now we're about, halfway there, I guess. Well, at least at one point we were halfway there when we bounced right here recently. We would still see another, 20 more percent decline. In fact, more than that from where we are right now. It'd be another almost 32% potential decline to get back to what would be, which would have some confluence. It would actually be a major area where it was resistance back here in 2018, again in 2019, and one final time in 2019 before it finally broke out. During the COVID pullback, it obviously wicked below it, but still kind of a level to look out for. So there is some confluence there, but you have to imagine, well, what would that mean for Bitcoin? And the easiest way for me to think of it is, where was Bitcoin at the last time that the NASDAQ 100 in this case was at this level down here of support, which would have been, early April of 2020. Well, let's go look and see. And lo and behold, here is our Bitcoin weekly chart. I've already put this nice little purple vertical line here to show you where price action was at early April of 2020, and check it out. It was right after the COVID crash where it had retested the 200 weekly EMA and SMA moving averages, and we were at around $6,000, which there's a lot of confluence there as well because previous blow off top for this bull market of 2017, early 2018, that was where it had been finding support for a long time when it was in this descending triangle before it capitulated one final time. And later it acted obviously as support again, or it was approaching that level during this time period, this falling wedge that broke to the upside from that level. And, you know, it recovered pretty quickly around that level as well after the COVID crash. That's where the candle bodies closed. So that level has a ton of confluence. It's a level I don't think any of us expect to ever visit again, and definitely a few years ago would have never expected to even think about visiting again. But I just wanted to mention that because, hey, if things were to get as ugly as they did in the previous recession, and we won't know that for, you know, several months to maybe even a year, then that's just something you need to keep in mind, is that a lot of these price targets that even I've mentioned in videos like 14K, you know, 16K, my famous area that I said I'd go all in at, which was around 12K, and I still believe that as of right now, that if it gets down to that level, I would, because I would just assume, hey, it's going to recover at some point above that, and maybe even rather quickly. But this might actually be the real level to keep an eye out for if things get ugly. The last two thoughts that I'll put out there just before I wrap this video up will be, if we have a little bit of a softer landing, so to speak, this time around, where we don't just completely come back down on something like the price of oil, like we did back here, where it only took 200 days and it just went plunging. If it's a little more of a traditional pullback where you have, you know, major bounces along the way and takes more time to play out, I guess from the long-term accumulation standpoint, that would be a little bit, I guess, sad, because it means it would take a lot longer to find the true bottom. But if you are someone that likes to day trade, or, you know, scalp trade, or even just open up short-term to mid-term trades that, you know, you only hold for a few weeks at a time, then this might be the way you prefer to see this play out. And if it plays out something like that, I would be just looking at these major levels, like this blue box down here, and I'd be looking for bottoming patterns on daily and possibly, you know, of course, weekly time frames, to consider holding on to something midterm. You know, for example, let's say we come down here over the course of the next few weeks and we bounce somewhere down here at like $85 a barrel, you know, and let's say we come back up and then we do something similar, you know, and eventually we flip this back as support. Things like that I'd be looking for to see major bounces, right? And then, you know, if that, once that level's lost and you've, you know, made some money on some of the bounces, then you'd be looking at maybe this next major level down here that was resistance twice and then support most recently, you know, as it interacts with this area, you know, in the future potentially, same thing, look for some sort of bottoming pattern to be put in, maybe a large falling wedge that it breaks out of and puts in a higher low and then, you know, trends higher. That's what I'll be looking out for in the midterm, just to try to find ideas of when I can make, you know, more sustainable trades. But as far as finding the true bottom, we'll just have to keep an eye on what inflation data comes out, etc. And my second thought was just, I mentioned in yesterday's video I was going to discuss things like Amazon and Apple. As I started making today's video, I realized it didn't really make much of a difference discussing what their prices were doing during these time frames, because at the end of the day, it was just made more sense to stick to the actual like NASDAQ 100, which is an accumulation of, you know, tons of stocks. However, just to finish up, you can see that Amazon, this is what it was doing back in the recession at least. When oil peaked, it was right here, and then eventually it rolled over just like everything else and found support. It saw around a 55% drop from the time oil peaked and when it bottomed. So if you found that interesting, there you go. And that should be about it for today's video. I know that was a little bit of a longer one, so thank you for sticking with me to this point if you did. And I hope you found some value in that. I know I definitely found some of that pretty interesting as I was diving into those charts. And as always, if you guys are liking the content that I'm trying my best to provide to you, do me a favor and like and subscribe, and we'll catch you tomorrow. It's tea.